Welcome to the Scalable Real Estate Investing Podcast, where we discuss the most scalable strategies, tools, and approaches to successfully invest in real estate. Learn how to make the most impact of your time, automate your real estate investing business, find off-market deals with minimum time invested, and leverage your capital to create as many income streams as possible so that you can achieve true financial independence. Thank you for tuning in. I'm your host, Mason Clement. Hi, scalable investors. Before we get into today's episode, I'd like to tell you about a group that I'm a part of called HiveMind. If you're serious about taking the next step in your real estate investing career, then this is definitely a group that you need to join. Some of our members are making $90,000 or more per month and as much as $300,000 on just one deal. And at the same time, you don't have to spend thousands of dollars like you typically would joining other mastermind groups. This is only $99 per month. And when you join, you'll gain access to a robust integrated CRM software that allows you to track your leads, run automated triggers, and ultimately scale your marketing efforts. So the difference here is that you're not left high and dry, but gain access to a support network that allows you to use that tool and learn from other more experienced real estate investors. So to learn more, go to scalablerei.com/HiveMind. That's HIVEMIND. Thanks a lot. Let's get into the episode. Hi, scalable investors. Thanks for tuning in to another episode of Scalable Real Estate Investing. I'm your host, Mason Clement, and today I have with me Tim Milazzo, who is the co-founder and CEO of Stacksource, which is a really interesting tech-enabled commercial real estate financing platform. And prior to Stacksource, he worked for tech giants Facebook and Google, where he helped expand their B2B marketplaces in ad tech. So really excited to have him on the show and get into things. Don't want to steal your thunder though. So Tim, what's going on today? How you doing?
Mason, thanks so much for having me on. Doing great. I think we both were grinding a little bit late last night, and with our coffee this morning, we're right back at it, huh?
Yeah, exactly. I'm glad we could both make it though. It's not easy to make ends meet sometimes, but yeah. How about we get into things in terms of your background? Like why real estate and why Stacksource, and what got you to today?
Yeah. So I grew up in New Jersey in the suburbs of New York City. And my dad worked in real estate in the city. And, he would take the train in the morning, and I saw him kind of take a briefcase and a suit. And as I grew, I learned, well, what is it that he does in the city? And it was commercial real estate leasing. So he was helping office landlords and office tenants, strike these multi-year leases with big companies in New York City skyscrapers. And that was interesting because he would come home with stories of these sometimes billionaire personalities that own these towers in New York, and how a tenant lease negotiation would go. But as I grew, I never thought I would follow in those footsteps. I studied finance. I interned for a big real estate services firm in the city. And my role as an intern is, hey, here's that smart spreadsheet kid in the corner, that can crank through all the analysis that we need to do. And, he'll do things with a spreadsheet that we can't do as brokers. But I was never driven by, okay, I'm going to make 1,000 cold calls and I'm going to out hustle the guy trying to beat me in the next cell over in the next cubicle, and making more calls in the first couple of years and grinding. I was never that sales oriented. And I always loved tech. I loved technology companies. I loved technology products, and smartphones were coming out, and I just said, I thought that's what I want to do. And I was able to level at a big tech company out of college, and I loved it. I thought I would always be at that big tech company or one similar and have the awesome perks and benefits. But we had acquired a startup into our division at that company, and some of those people started to leave the company and go to other startups again. I was like, what are you doing? Like, you're getting paid well. You're at like this brand name company. We've got chefs cooking us food all day long. Like, what's going on? And I started to learn more about startups and like entrepreneurship. And I got the opportunity to go to one of these startups as like a first hire in a new role they were creating, which was the type of role I was at in sales operations at the big company. And I was super curious at that point. I went to this startup, and it started in me like this slow burn of like getting the startup itch, which eventually led to like, not only do I want to be at a startup, but I want to be building my own startup, and I want to build a product, and I want to try to build a company and learn everything I'm going to learn from that. That combined with this reintroduction to real estate, where I actually attended a real estate tech meetup in New York City, and my mind was just blown and opened to what the possibilities were in real estate tech and why it was the right time to do it, because we have this generational shift. People used to using technology in their daily lives. All of a sudden it gets to their job, it gets to the industry. Where is it? It's like there are all these opportunities to make things more transparent and more efficient, more data driven, and people were working on those types of startups. So that is my background. I love tech. I love real estate. Didn't think I was going to be a broker, but here I am now, in a sense, building a brokerage. So I kind of came to a weird spot.
Okay. Yeah, I think it's interesting because real estate's always kind of seemed like it's been slower to adapt to the tech trends. So it seems like there's a lot of opportunity there. So
yeah, the transactions are slow too. I mean, you're not transacting every day. This is not like a mobile payments platform where you're paying your friend and, oh, that was an easy way to pay my friend. And like, now you're going to use it like 10 more times this week. I mean, you're going to, how often Blackstone buys buildings every day, maybe. But the average real estate investor, I mean, this is a multi-year investment process. So I think there's some built-in reasons why, change is slower in real estate.
Yeah, that makes a lot of sense. So how would you describe StackSource? I don't even know if we hit on that. StackSourcecom, people can go there, check out your company. What is it exactly?
Yeah. Okay. So in all this array of what happens in real estate between leasing and buying and running your property and property, there's so much that happens. Financing is one of these key things that happens during the acquisition process, or you can refinance, or development. I mean, those are the three times usually when you're financing a property. You're putting together the capital between your own money in the bank, your syndicated investors, the loan. And by the way, the loan that you get is typically the majority or even most of the capital that's going in on the property. And the rate and terms that you get on that loan and like getting the right financing partner is one of these extremely key things that like determines whether you like make higher returns on the deal. And we kind of looked at that part of the industry and said, wow, there's no transparency into if I call this bank versus if I call that credit union versus if I'm taking an agency loan with Fannie Mae or Freddie Mac. What the heck are the rates today? Like in residential mortgage, there are dozens of websites you can go on to figure out where rates are today. You can get a pre-approval in 10 minutes by just clicking and like inputting information about your income history and like your credit score. And you basically have your rate right away. Oh, cool. Like I'm at a 3% fixed for my primary residence. Commercial financing, it's been so in the dark. You've got to call the right person who's got the right relationships with the lenders. You've got to do all of this back and forth that usually takes like days and weeks to just get the package ready. And then you're sitting there waiting on, oh, well, we don't have the most up-to-date quote. And I'm going to lose this LOI with the seller because like I'm running out of time now. And I'm literally waiting on a loan officer to finish a round of golf. Like this is insane. So commercial financing has been this area that has completely lacked transparency and efficiency. And it shouldn't, because it's mostly based on math and data and a particular lender's risk tolerance. And bringing those things together and giving you, here are your loan options for this multifamily property, that's something that should be wildly more transparent than it is. And so that was this huge opportunity that we've jumped into with StackSource. So StackSource is a financing platform that's bringing transparency. You give us a property address, you start to input information about the income and the number of units. You give us the information that's actually needed to run that math, and we'll run the math and we'll tell you, here are financing options for a multifamily or for commercial. Multifamily is about half of our deal today. The other half would be other commercial real estate asset types like retail, office, medical office, industrial. Starting to see the comeback of hotels right now, though that's not a huge part of our business. But that's StackSource. We're bringing transparency to financing because it's needed.
Okay, and I guess if I'm an investor, I just post my profile there. Well, I guess the specifics of the deal, like you said, and then that's what. Is it like your algorithm crunching the numbers, or is it lenders actually going there and viewing it and then making offers?
Sure. Okay. So we're still, though now we are a few $100 million of loans originated. We're still in the process of building this platform to what it'll ultimately be. So the short answer is this: some loans you can get an instant quote, and we just launched that last month. So 2021, somebody may be listening to your podcast a year from now. We're talking in April 2021 here. Just by March, we launched our instant quotes for stabilized multifamily assets. So if you are buying a stabilized multifamily asset that would get a loan like $1 million or more, but is still like, 1 to 6 million is the Freddie Mac SBL instant loan quote that we have. We have some larger quotes from HUD 223F. So these government-backed loan programs where it's like this strict underwriting box. You have to have 90% occupancy in the property. There has to be some seasoning. Like they're looking for certain things. If you qualify for one of those programs, you can get an instant quote on StackSource. Here's your rate, 3.84% based on the zip code and the size of the property and like, the other factors. Those are instant. If you're doing a property that you can't get an instant quote, or the instant quote is not a fit for you for whatever reason, then we have this network of hundreds of lenders where we make the process more efficient and transparent, but you actually are getting live manual quotes from these loan officers at these banks that are seeing our package. It gives them all the information they need to provide a commercial financing quote. And then you're getting multiple competitive quotes from different institutions. So you may have banks and credit unions competing for your small multifamily loan. If it's a ground up development, you might have a bank financing quote and then a higher leverage quote from a debt fund that is a higher rate. They're like a private lender, but they'll do more of the capital stack. And then you get like a comparison mode where you can say, hey, if I take the higher leverage, even though it's the higher rate, actually my IRR would be higher. And like you get that kind of, comparison. So there are really two paths. You can get an instant quote right now and you can upload the proper diligence and get right to term sheet, or you can chop the full market and we, kind of match you to every lender that is in market for that type of asset in that area. And, the 60 to 80 criteria we have about each lending partner.
Okay. And then I also noticed that as an investor, I would be partnered with someone from your company as well, kind of like a liaison, or what would their role be?
Yeah. Okay. So we get asked a lot, and especially in early days as we were just starting, it's like, oh, is this the lending tree for commercial real estate? Lending tree, you can put in one loan request and you get multiple lenders competing. Now, lending tree has been around for the 90s, but while they're still a company that's worth a few $1 billion and they're a good company, they basically sell your contact info to these lenders. And now you're getting calls from all these lenders like, hey, I've got a loan offer for you. And no, answer my call. I've got a loan offer. And now you're dealing with all the lenders separately. On StackSource, we didn't take that kind of mode. Basically, you have one point of contact, which is a StackSource capital advisor. These lenders don't get your contact info where they get to call you separately and make you loan offers. All the loan offers have to come back through the platform. So they're entered in your comparison, they're entered in your analysis mode where you can see, is this the best loan offer for me? And you get to talk to one person. You get to talk to the capital advisor who can actually do more than just connect you with the lenders, but can advise you on, well, let's talk about the difference between a CMBS quote versus a local bank and what your life's going to be like with this loan versus that one. Are we going for maximum leverage here? Are we going for bond rate? And they can actually provide like expert advice because these people have been lenders and mortgage brokers in their previous life.
Okay, but is there and also someone that kind of helps you communicate with the lenders, or I forget what it's called, a capital advisor?
Yeah, that's right. So the capital advisor is doing both. They're advising on the borrower side on, hey, what type of financing are we really looking for here? And then that's right. When the lenders have questions about the deal, they're able to go to the capital advisor as well. And so they're the liaison on both sides between the borrower and the lender. So that, again, as the borrower, you don't have to field, phone calls and like this, drips from dozens of different lenders. You have that one point of contact with the capital advisor. They're also, not only are they communicating with the lenders, they're actually negotiating on the borrower's behalf to try to get a better loan deal.
Okay, got it. And back to what you said about lending tree selling information, I think that's really encouraging that you don't do that, because I remember one time I did submit my information through there. I was trying to look for financing for like my first rent house a couple years ago, and I was just bombarded with, it was amazing, like just how many calls. And if I didn't pick up these robocalls, they would just hit me again. It was like, that was like exhausting. And I just started blocking all these numbers. So
again, I can't really knock on somebody that's built like a $4 billion business, but LendingTree was built in the 90s. It was a different day and age with technology and what could be possible of fintech. Last year, Rocket Mortgage on the other side IPO'd, and now they're worth $40 billion. And you get one point of contact. Now they're the direct lender. So that's a different model where you're not getting competitive offers from multiple, but you're also not getting your information sold to. So I think residential mortgages in some sense have moved beyond that LendingTree model as technology has evolved and as the industry's evolved.
Okay, that's interesting. I thought that Rocket Mortgage was similar to LendingTree, but I don't use either.
One lender on the back end. It's Quicken Loans is the same company.
Got it.
And Rocket Mortgage is actually owned by Dan Gilbert, who is the owner, if you're a sports fan, the owner of the Cleveland Cavaliers. That's his company. I mean, that's how, he made his killing in the mortgage business and bought the Cavaliers, and now, those are his two major successes.
Interesting. Yeah, it's a fun fact. I remember I was looking for like who owns the Cleveland Browns, and it's the owner of the Flying J convenience stores. Another trivial fact. Yeah, and that's why they're called the Browns, but they have this orange color because that's like in their logo, the Flying J logo. I think it's orange, red. Anyway, going off on a huge tangent.
I should have done that. I actually have a friend that works in marketing for the Browns, which is interesting. So we're making all sorts of connections here that will be more or less useful for your real estate audience. But now they'll be better at better at trivia.
Yeah, definitely. And also just one last trivia fact. I mean, I just have to stay in tune because although Baker Mayfield went to OU, he is from Austin, Texas. I'm a fellow Texan as well, born and raised. So I got to support a Texan,
Okay. And they've been exciting. Oh my goodness. They're the best Browns teams in decades.
Yeah, exactly. It's always interesting just to like watch like him and also Tom Brady just like go to these random teams that are usually underdogs and just kind of revamp the whole thing. So yeah, this isn't a sports podcast though. So we'll get back to this straight and narrow here. Huge football fan though. Like actually March Madness was crazy though too. Just amazing how much actually marketing gets put into the college basketball side of things. I previously thought it was like NBA, and it's like, no, it's all about the college national championship. But anyway, for your platform, say I'm like a new investor and looking to get funding for my first deal, do you think it'd be appropriate to go to your platform to try to get loan offers or lenders looking for seasoned veterans?
Okay, so the financial strength and the experience of a sponsor matter for commercial financing. And only one of those two things matter when you're getting like a residential. So if you're talking about buying a single family rental or a 1 to 4 family multi or something like that, it may be the easiest thing to simply just use a residential mortgage, especially if you have the income and the credit score and the because that's the only thing that matters. That's your underwriting, that's your rate. As a matter of fact, I would recommend use a residential mortgage when you can in that less than 5 unit space, because there's no prepayment penalties, it's non-recourse. You hop into commercial financing for the first time, and you have to do that if you're getting 5+ unit multis, if you're getting, even if it's like 2 apartments over 1 retail unit. Now you're in commercial financing, and you have to use commercial financing, a commercial mortgage. It is really easy to get taken advantage of on your first commercial financing if all you do is go to the local bank you have a relationship with, because they may or may not be the best commercial mortgage lender. You may get a full recourse quote with 20 years amortization and 65% max leverage, and the rate's at 5%. And if somebody is listening and that's the loan offer they have right now, turn it down. Don't go with that financing. There are better options. So absolutely, you need to shop around for a loan. If it's your first time, experienced commercial real estate investors that are buying $100 million property still shop around for a loan. No expert goes to one lender, trusts that they're at market, and closes. That just does not happen in commercial real estate. If you're a newbie, don't do that either. Now, your lack of a track record will be an underwriting, it'll be a hurdle. It'll be something to mitigate and to overcome. That may mean you're not going to get max leverage on the first deal. Doesn't necessarily have to mean that. There are lenders that can. Right now, as of like Q2 2021, there are a lot of lenders with a bunch of cash sitting on their balance sheet. And they need to make loans, and they need to make some sort of yield on that cash. And commercial mortgages are a great way to do it. There may be some credit union that you can technically become a member that would give you a better rate because they just have to get money off their balance sheet and they have to get it working on something. They're losing on auto loans, and they want to make a commercial mortgage. They want to make 4% on their money, and you could be a good borrower for them. Different loan options will become available the more experience you have, and there's a ladder there. You can't get a Fannie Mae loan on your first time. Usually, I mean, there are ways to do it where you bring in a guarantor that has the experience, or you're teaming up with a property manager that has 100 of these that are. There are some tricks, but there's an experience requirement, and different lenders may not have an experience requirement, but it's a factor. It's a factor they look at when they're thinking about rate. It's a factor they think about when they're looking at loan approval. And actually, the person you're talking to at the bank is not the person that decides that. There's a credit committee behind them that looks at the file that the loan officer has written up in a memo and says, is this a worthwhile investment? Is this, have we mitigated the risk here? Is this a worthwhile loan to make? And you may not find that out until 2 weeks after the loan officer said, yeah, we can do the deal, which is another problem. We have helped first-time investors that have tried to call 40 banks and not gotten their deal done. And then they submitted to StackSource, and we got them the right term sheet in a week, and they were closed in 50 days. On your first time, teaming up with an expert is something that you should do in every aspect. You shouldn't try to negotiate the LOI without a good sales broker. You shouldn't try to negotiate financing without a good capital advisor. You certainly shouldn't try to negotiate loan docs or a purchase contract without a good lawyer. Like, you need to surround yourself with the right people and the right team. And what we're good at StackSource is one thing. We're really good at commercial financing. We know who has to get money off their balance sheet and make a loan this month. Those are just things that you have such a hill to climb. You can absolutely go it alone as a first-time investor, but it will be more difficult. And you may not get the best loan terms. You probably will not.
Okay, yeah, that all makes a lot of sense. Reflecting on my experience, I was looking for financing the second half of last year for 2 self-storage facilities next to each other, and just shopping around, and all these things were incorporated. But I think I was on that deal myself, but I was in a mastermind, so I was kind of getting this information fed to me on what to do. So sure. It was helpful. Yeah. I actually did mention the mentor in my bio. It's like, this person's like my advisor to the company, and try to help a little bit. But they did require tons of things, like life insurance policy for me and my wife, personal guarantees, second liens on our rent houses, like everything. We also were W-2 employees, so they require, maybe even if shit hits the fan, a garnish on our wages or something. I don't know. They didn't have that in the paperwork. They were probably considering if, there was a problem.
Was that a local bank that you ended up closing with?
Yeah, that was ultimately the deal fell through like 2 weeks before closing because of the zoning issues with the property. So it was pretty,
sounds like you
pretty
had some lessons learned.
Yeah, there's some huge lessons learned, but dodged a bullet there because just to put down the money, like the down payments, like $80,000 that we suddenly could avoid, like assuming this huge risk. But we did shop around a lot. Talked to like one loan broker who had her network, but then she was taking forever to get us anything. And so I was calling a lot of different local community banks. And this was like a community bank that has mostly locations in secondary markets throughout Texas.
Yeah. But
nothing else beyond that. So they offered a pretty competitive rate though. It was like prime plus 1.5. So it was like a 5% rate. And I forget how long it was fixed for, but yeah, it was, decent terms, but there was like tons of guarantees to put on there and strings attached. But it was our first deal, so I wasn't shocked per se.
Yeah, that makes sense. It sounds like probably on properties like that, and digging into the underwriting of self-storage, once you get a stabilized self-storage asset and it's performing well, that's absolutely the type of thing you can look at rolling into non-recourse. Or one tactic there would be negotiating a recourse burn-off, right? Where it's recourse for the beginning. You're a new investor, maybe the performance of the property is not there, but as you reach certain hurdles that make this a less risky investment for the bank, hey, once we reach this DSCR hurdle, half the recourse burns off, or 3/4, or the full recourse burns off. And we've kind of negotiated structures like that on certain properties, and self-storage is absolutely one of those property types where that's possible.
Okay. Interesting. Yeah, I was actually wondering what different allocations. You said that about half is multifamily loans, and then how much do you see in self-storage and other property types like throughout?
Yeah. So for us in particular, it's multifamily number one, retail actually is number two. And retail has had a really choppy last year since the pandemic. There are good, there are places where retail has been affected a little bit. There have been places where retail has been shut down and the tenants are gone, and you're dead in the water and you're under your loan. And there's everything in between. One sector of retail that's done really well has been credit tenant net lease. So if Starbucks has promised to pay you rent for the next 15 years on that out parcel, and you own, it doesn't matter if the economy's struggling, it's Starbucks. That underwriting is as good as gold. That's still very easy to finance. They probably paid rent the entire time through. They had a drive-through, so they weren't losing their rent. So there's winners and losers in retail. So we do multifamily, retail, office and medical office, industrial and self-storage would make up the final 10 to 20% of the financing volume that we do in particular. Self-storage is really making a push to try to be recognized as the sixth big asset class for commercial real estate. So it's traditionally been the first four I mentioned, plus hotels, and hotels have had a terrible year, though they're coming back. Things are starting to trade in Vegas again, and get recapitalized, and different states and different cities are opening up at different rates, and people are getting vaccinated and able to, kind of have a level of comfort to travel again and things like that. So self-storage is really making a push to be recognized as another major asset class. I don't think it's, quite there yet, but it's performed very well in many areas. So, and it's in high demand. People living in apartments, they don't have garages they can put their stuff there, and obviously the rise of multifamily kind of goes hand in hand with the rise of self-storage. And the underwriting isn't too dissimilar. I mean, people don't move out of their storage unit too often. Even if it's a month to month, your chance of a turnover in a self-storage unit is pretty low if it's in a high demand area. So, it's once you get a stable self-storage asset that you can cash flow, it's a great investment.
Definitely. It's kind of the forever cash. And I've heard some tenants are there, 10 plus years, they're ultimately spending more on the rent for that self-storage unit than the stuff inside it. There's eventually, I don't know if people actually consider, there's a certain point.
People don't like parting with their stuff. I mean, hoarders, and that's why you have all these shows about, storage wars, and people opening up storage units that have been abandoned, or the person deceased and didn't leave it to anyone, or, to your point, there are some people that open up a storage unit and it's on recurring payments on their credit card, and that's as good as a bond.
Yeah, definitely. Just a small note there. So definitely good. I remember you mentioned that there's debt funds and credit unions and banks. So instead of the allocation of property types, what's the allocation look like for the lenders that are involved?
Yeah, for StackSource, we do a lot of placing debt with banks and credit unions. We have a particularly strong network of relationships with banks and credit unions across the country. And we keep the pulse of what types of assets can they lend on right now, and what are the current terms, and what can they offer, and what are their underwriting constraints. And what that does is helps us. Let's say you have a small multifamily property. It doesn't qualify for, Fannie Freddie underwriting, or you have a small self-storage and there is no government agency financing that's available. you're likely, if you want the best rate and terms, and it's not a property that's going to go with the commercial mortgage-backed securities market, which is kind of larger, more stabilized properties, and that's a non-recourse option, but it's not as easy to deal with. You're likely going with banks and credit unions. And there's so much difference between the loan offer you're going to get from one bank versus another bank versus the credit union. And it's difficult to shop around and to call them all and to deal with them all. And if you don't have a relationship with them, you may not be getting the best quote anyway. For StackSource, if they know we have another $1 billion of loan requests that they can potentially see in the next year or two, they're going to give us their best. They're going to put their best foot forward when submitting terms on our platform, because they know they're not just dealing with one borrower that's asking for a loan. They know it's actually going to be reflective of whether we send them more deal flow, whether they're going to have a higher rating on our platform, whether they're going to be able to compete on the next deal. And so these banks and credit unions are usually putting their best foot forward as far as rate, terms, fees. We can negotiate them and we know where they can flex. And so we place a lot. The majority of our loans are closing with banks and credit unions that are not the name brand banks and credit unions that you think of on a national scale. It may be, if you're an investor based in California or New York, maybe you're buying for yield and a higher cap rate in the Midwest or in Texas or in the Southeast. There could be a lender that's in neither of those places. There could be a bank that's in Oklahoma that looks at Texas and says, okay, that's our neighbor to the south, and they're buying a multifamily property in North Texas, like that's close enough for us, and we have money on our balance sheet. You would have never thought to call that bank in Oklahoma, but they're on our platform and they're matching, and they're going to put their best foot forward with rate, terms, fees, and that could be a great loan for for that sponsor that's based in California. So that's like one example. So the majority of our financing is done with banks and credit unions, but we also place loans with Fannie Mae, Freddie Mac, in certain cases for larger, more experienced sponsors with life insurance companies. And then for deals that are transitional, they're heavy value add, that's more likely to go towards debt funds and private lenders.
Okay, like a distressed deal, or not necessarily distressed, but I guess a class B or C with tremendous value add, or?
Yeah, it could be, but let's say there's a lot of deferred maintenance from the seller, and just doing the basics on the property is going to help you raise rents by a couple $100. And let's say that you underwrite a property and it can believably be worth 25%, 30% more 18 months from now by executing a business plan of new carpets, new paint. You're going to have to redo the kitchens in a number of units. And I'm speaking in multifamily lingo here, but it can, it can be something else for another asset class. But you have a believable, a believable value add plan. This thing's going to be worth 25, maybe 50% more. That's where a 2-year IO loan, you're paying interest only, and you have a flexible lender that you can prepay at any point when you finally reach that point where, okay, I've maximized the value here. I'm ready to refinance into my 10-year fixed. Don't get into the 10-year fixed right away, because that 2-year IO loan, even though it's a little bit higher of a rate, maybe you're paying 6-8% on your interest rate. You're only paying interest. It maximizes the cash you have for that rehab in the short term. Maybe there's an interest. Maybe there's a reserve. There's a capital reserve that you can tap as those units are turning over, and they're reimbursing you for fixing up those units. And that's something that you don't often find from a bank, maybe with a lot of experience, and there are certain banks that have programs like that, but maximum flexibility, capital in reserve to make your improvements. That's where a debt fund can come in real handy. They can close in 30 days. You can get your project started right away. They're going to have a more flexible draw on those capital reserves than a bank with all this red tape. And that could be a really good financing partner. You get in and out of that loan in 18 months. And when it's worth more, you're doing a cash out refi, getting your principal back and rolling it into the next property. So that is another common play, right? And it's a play that you don't necessarily want to be haggling over the lowest interest rate and getting into the 10-year fix, because now you can't refinance for the next few years because there's this heavy prepay penalty. So flexibility, max proceeds, lowest rate, it depends what your business plan is. You may want to go for the lowest rate. You may want to go for max proceeds or the most flexibility. That's the type of thing that we're talking with our clients about every day. Hey, what really is your business plan? How can the financing really help you accomplish it? And what are your returns going to look like on this entire project over the next 5 years?
Okay. Yeah, there's a few things I'm thinking of here. One thing, do you ever have like hard money lenders that, or maybe these debt funds will do it, where there's just, it's kind of like a mismanaged storage facility, for example, with pretty poor financial history records and no website or anything. So people do that, or is that just like, should I just go straight to the hard money lender and not bother with your platform?
Okay, so we close very few, if any, hard money loans in the sense of like, I think, so there's not really a clear line of definition of like, what is a debt fund or a private lender versus hard money, but hard money is usually full recourse, high rate in the double digits, maybe 12. I've even seen hard money loans at like 14% interest. There's heavy fees. Maybe you're paying 2, maybe you're even paying 3 or 4% fee, origination fees. There's fees on the back end to get out. When I think debt fund and like the types of lenders, those types of lenders, if we even have a few on StackSource, they're almost never winning. Like they'll submit a quote and it's like 12% and 3 points, and hey, let's get you a loan at 9%. 2 points origination. A capital reserve to accomplish that business plan. If you have a legitimate business plan where there's going to be value added and you have a level of believability, and we can help you add that level of believability to the package and the underwriting, we can help you go through the underwriting on a big value add project like that. StackSource's analysts are going to help you with the underwriting and the pro forma and collecting comps. The idea is, let's build a believable business plan and connect you with a lender that's not really going to be hard money. Like they're a debt fund, they're a private lender. Is it bank rate? No. But is it 14% and 3% origination? And like, you have to sign over your first child if anything goes wrong? Also no. So hard money lenders, if they've ever won on StackSource, it's been very rare. And it's been like a really hairy, difficult deal where like, the underwriting is questionable, and let's work on getting a believable business plan in order, and let's get you into a softer private loan.
Okay, that makes sense. And you said that you might close within 30 days of the debt fund, but the banks and credit unions, they usually take 50 days?
The fastest banks that we have worked with can close in about 45 if everything's going smoothly. And that's, if it's a clean deal, we're ordering the appraisal early, and, there are some things that if you're in a tight closing timeline, you start getting things done early. You might need to pay a bigger deposit right up front to do like a rushed underwriting. But banks typically 60. Some banks can take even longer than that to close. And so like, with the StackSource Capital Advisor, we can say, okay, here's the best rate and terms, but this bank takes 70, 75 days to close on average. That doesn't work with your acquisition deal. It's got to get done by year end, for tax reasons. So that you can't go with that lender and close by year end. The fastest private lenders can close in 2 weeks. The fastest loan that we closed was in 2 weeks. That is, there's no bank, there's no red tape with the underwriting and going to some credit committee. It's with a private lender. That's a more expensive loan as far as the interest rate and the fees. But there are situations where you're going to fall out of contract, and just getting it done and getting it closed, it's of the essence. And at that point, it's possible to close in 2 weeks. And anything more than like, once in a while we get an inquiry, okay, my other lender fell through, can we close next week? Very, very difficult. The earlier you get in and, describe the deal and get that approved, StackSource will need to approve you, and we can approve a deal quick if it's time of the essence. We certainly don't let everything flow through to our lenders. As a matter of fact, the majority do not flow through to our lenders, because we can give some financing feedback and we can say whether that financing even makes sense. And, are you engaged? Do you have the property under contract? But really 2 weeks, the earlier, the better. As a matter of fact, getting involved on day one to try to get the best financing. And, if you go with your own lender and something falls through, it's better to already have a backup plan in place. But 2 weeks is about the fastest that a commercial financing can close.
Okay, that is interesting though. You're vetting the deals, so it's also value add for the lenders. So they're not just sifting through tons of volume. They're kind of getting a more refined trickle that goes through the filter already.
Yeah, banks and credit unions would not be here. This would not be possible unless we were really good at vetting deals, and not only vetting deals, but like targeting them to the right lenders. Like banks don't even care if it's a good deal, if it's something that's out of their footprint. Like that's a good way to get them to stop paying attention on an individual level or on a platform level. So we have to be good at vetting. We also have to be good at targeting, hey, this is the right deals to send to this lender. So there is no view where lenders on StackSource can see everything. They're only getting alerts when there's something that's within their strike box where we're allowing them to see it.
Okay, interesting. Yeah, that's encouraging. Maybe there's some lenders listening to our episode here as well. They can see, oh, this is a good way to increase the loan portfolio.
Sure.
I'm going to change gears a little bit. I noticed that you're raising money on wefunder.com. So could you go into that and like what you plan to do with the capital, and could I still invest now? Would I get equity if I invested? How's that work?
Sure. Yes. So for all that we've helped people get financing on all these commercial properties, and we've done our first few $100 million of commercial financing origination, we haven't taken on a ton of capital for StackSource. We took on an angel round, which was a few like kind of friends and family, and then a couple of small funds like Techstars and New York Venture Partners. We put together a few $100,000 to spin up the platform and to get it built and to get our initial traction and build the team. We've now gotten to the point where, all right, we've got 7-figure revenue. We're growing our originations at a fast clip year over year. We need to build it further and build the next iteration of the platform. As we're taking on more capital, we're doing that through WeFunder. As of right now, as of recording, we're at about 80% full towards our goal. So we've raised commitments of $1.8 million on the WeFunder platform. That includes a lead investor that is bringing $1 million that we negotiated these terms with, and it's kind of led the due diligence and kind of set the terms of the round. And then we're allowing follow-on from StackSource's clients, other investors in the space. Anybody who's interested in startups or commercial real estate finance is actually able to participate. WeFunder does regulation crowdfunding. So that means you don't even need to be an accredited investor to invest in startups on WeFunder. So we have people investing as small as $100, as large as $100,000 in our round, because they like the idea of commercial financing being more transparent. They believe that that's needed in the industry. And there's a lot more information about our business plan and what we're going to do next. So that's all at wefunder.com/StackSource. Or if you go to StackSource.com, there's a little banner at the top. And as long as that round is still open, that banner will be at the top of our website saying, hey, check out our business plan on WeFunder. I actually go into a lot of detail. Transparency is our thing. I go into a lot of detail of what we're going to be building next, what types of instant loan quotes are going to be available on StackSource in the future, what the team will look like and what our background. So actually all of our business plan, which our competitors may be rejoicing, but I don't care. We're about openness and transparency. Our entire business plan is on wefunder.com/StackSource, and that's kind of the opportunity to become an LP in what we're building here.
Okay, interesting. Yeah. So there's actually equity though. It's not like a Kickstarter campaign or something where you're just kind of donating cash, right?
No, it's preferred equity. It's actually convertible to preferred equity. So let's say you invested $50,000 in StackSource today, or whatever amount. That's the principal amount. If we IPO or get acquired, or if we raise another round of funding where the valuation of the company is set, you're then converting to preferred equity shares based on the amount that you invested and the valuation cap that's set there. So it's something where you're getting preferred equity in the company, and as the founder, I'm the common equity as kind of the GP. So it's very similar to a real estate deal in that way, though it's just a convertible equity scenario that's very common for startups.
Okay, and I guess if I was to invest, all that documentation will be provided on the details, the structure.
That's right, and we needed to register with the SEC to do this regulation crowdfunding campaign. So like all our financials, all like the compliance information is actually registered with the SEC, and we have to be compliant with that. And we have to give ongoing updates for the company to the investors and to the SEC. So you'll see like each year exactly what our accounting was, and that gets reviewed by an independent CPA So this is not just us saying, hey, we're awesome and, come invest in our tech startup, but this is actually, hey, here's our full financials. This stuff has been reviewed and vetted and all the due diligence stuff.
Okay, interesting. So yeah, I could just look up SEC filings as well, huh? On
Yeah, those will be linked right from the WeFunder page.
Okay, very cool. All right, so we've covered a lot here. Do you feel like there's anything else that we're missing?
We are always happy to talk commercial financing, not just in general, but if somebody has a question about, what type of financing could I get for that property? One, a capital advisor on our team is always happy to talk in general. Like, hey, you don't even have an offer put together here, but let's just talk in general for properties like this. These are the array of financing options. Use these as your assumptions in your underwriting model. And we're always happy to have that kind of conversation. As a matter of fact, we are building that kind of as a tool that is available to investors. So another recent release is we released a browser extension. If you're using Google Chrome and you're browsing a commercial property listing, you can install our browser extension, and any listing website you're on, you can click the StackSource logo that'll come up, and it'll do a commercial financing calculator right on the page. And not only that, it will let you use an instant quote if one's available for that type of property, or enter financing assumptions, and it'll tell you right away, here's how much equity you would need to buy that property, here's what the cash flow would look like after the loan payment. So that's something that's brand new too. It kind of goes hand in hand with we want to be helpful, and that's free. Anybody can use that. You don't have to use StackSource as your financing service. You can use the browser extension for free forever, and you can get instant financing quotes. You can get approximate financing quotes, and so that's the StackSource browser extension. But we're also happy to do that on a human level, and capital advisors take calls and just help think through and talk through the underwriting of a property. And so take advantage of us. That's something else I would encourage people to do.
Okay. Yeah, it seems like if I was anticipating using your platform, it would make sense even before I have a deal just to kind of connect and get everything set up and have you vet me first.
It's you get us involved as early as possible. You're looking at different properties. You're thinking about writing an LOI. Maybe you're not ready for live financing quotes yet, but just to think through the strategy and, is this going to hit my investment goals? Absolutely.
Okay, great. So yeah, I will be sure to include all these links, StackSource, WeFunder, everything in the show notes. Is there any other contact information you want to leave for our listeners, for folks to get in touch with you?
Sure. I'm Tim at StackSource.com. If anyone wants to get in touch with me, I'm active on LinkedIn, Twitter, Facebook. If you search Tim Milazzo, I'm usually the first that comes up. So Tim at StackSource.com. I'm happy to connect with anyone that is interested.
All right, fantastic. Thank you very much for taking the time to do this. I think that it's been a really interesting, insightful episode.
Awesome. Thanks so much, Mason. Really appreciate you and the education you're doing for your audience.
Sure. It's a great way to give back. Hopefully people are gaining something from this. So
I'm sure they are.
Thanks. All right. That's another episode of Scalable Real Estate Investing. Thank you for tuning in. Please be sure to leave a review and subscribe on whatever channel you're using to listen or watch these episodes. And also be sure to go to scalablerealestateinvesting.com, scroll to the bottom and fill out the form to sign up for our email. And you could also reach me directly at mason@scalablerealestateinvesting.com. That's MASON at scalablerealestateinvesting.com. If you'd like to get in touch with me to either partner on deals or even be considered to do your own episode on this podcast. Thanks again, and have a great day.